Hi, everybody. Good evening. I'm Christy, and here's David. Hope
Evening.
everybody survived the rain. We're going to walk you through a few items for 2023 tax prep. Let's see if I can pull this up. Go back over here.
While she's getting that started, I just wanted to thank everybody that has signed up for their yearly engagement. For those that haven't, please do so. We do need to get all those engagements in and signed before we can do work for you this year. So if you're having any problems on that side, please let us know, and either Matt, myself, Tracy, and Christy can get you set up.
That.
Hey, we did it.
We did it. We're going to go through a few topics this evening. We're going to talk a little bit about filing deadlines, the employee retention credit, beneficial ownership information, Section 179 of bonus depreciation, and there's been an interest rate increase for unpaid balances for both the IRS and California that we'd like you to be aware of as business owners. As you know, the upcoming filing deadlines are looming. Your 1099 NEC should have been filed. If you think that you have a couple outstanding, please reach out to us soon and we'll get those knocked out for you next week. We've got 1099 interest, rent, etc., that are due at the end of February. If you are subject and need to file an LA City business license or any other licenses, please check the due dates. Most are due February 28th as well. And there are usually fees associated with those filings, and they will penalize us if we file late. March 15th, you've got partnerships and S corporations, pass-through entities that are due to be filed. And I'm speaking about calendar year entities. 4/15 is the due date for C Corps. The employee retention credit. I'm gonna turn it over to you.
I get the fun ones. Employee retention credit was a program put in by the IRS during COVID. This program has seen a lot of changes over the years since it got instituted in 2020. The ability to claim the credit initially was limited, especially if you had a PPP loan. The initial guidance or the initial law basically said if you had a PPP loan, you weren't entitled to an ERC credit. And so a lot of people didn't file with their original returns. That law did get updated and changed, and the credit actually became larger for tax year 2021. In 2021, they essentially backtracked on their initial guidance, and they said, no, you can claim the ERC, the employee retention credit, even if you filed and received PPP money. And they increased the credit. So in 2020, the ERC credit was 50. If you had a drop in revenue of 50% or greater, you were entitled to a credit up to, I believe it was $10,000 per employee per year. And it was a percentage of the wages that you paid. That credit increased in 2021. Essentially, in 2021, the IRS basically said you were entitled to a credit equal to 70% of the employee's wages. And it did cap out, but it was $10,000 per employee per quarter. So there was significant money on the table, which was good for people that were impacted by COVID and lost a lot of revenue during that time. Also in 2021, they lowered the threshold. So you only had to suffer a 20% drop in your revenue compared to your 2019 base year for the same quarter to qualify. So they drastically increased the credit and they lowered the threshold for you being eligible for the credit. what that led to was a huge amount of interest in filing for these credits. And they said you could basically, if you failed to claim the credit on your original employment tax return, you could go back and amend the tax return just to file for the credit. What happened, unfortunately, was there was a lot of bad actors and a lot of promoters or people that were encouraging businesses to file for these credits. And with that, they probably misled or um, misrepresented to their clients that said you were eligible for these credits, and they were filing for everybody. They basically were getting businesses on the phone and claiming, hey, you qualify. If you haven't filed, let us do it. You can pay us a fee. And they were normally charging you a percentage of the credit that you received. I want to reiterate, right? If you did have a legitimate drop in revenue and you qualified under that, you're probably okay. But if they were telling you that you qualify because there was a supply chain disruption, or you were told by the government that your business had to shut down because there was a stay-at-home order by the local government, those that gray area is what the fraud is, and that's where the IRS is coming down, and they've actually basically told their criminal investigation unit that they need to enforce this. So they are actively going after all of these ERC credits and looking for fraud at this point. All of this is to say that if you were one of those unfortunate businesses that did get talked into claiming a credit and you didn't qualify under the revenue guidelines, and instead were qualifying your credit based on a gray area or a subjective area, you should call us and let's talk about it, because there are some voluntary disclosure programs and some ways that you may be able to mitigate the potential liability that you may face. If you made an ERC claim and you are not entitled to that ERC credit, what can happen is the IRS is now granted up to 6 years to go back and look at these. So their statute of limitation is 6 years from when you filed your claim. You also are required by law to, if you claimed an ERC credit, you have to amend your tax return for the year that you filed that credit for. So if you filed an ERC claim for 2020 wages, you have to go back and amend your 2020 income tax return. And you have to reduce your income tax expense for those wages for the amount of credit that you receive. So you are in essence paying income tax on the credit, but your credit was worth more than the tax that you had to pay.
And depending on your entity type, that could impact a number of partners or shareholders or.
Correct. So if you were in an S corp or partnership, they filed for an ERC credit in 2020, and now they're getting that credit. It doesn't matter that you didn't receive the credit until maybe 23, or maybe you're still waiting for the credit even in 2024. If the credit was based on an amended 2020 payroll tax return, you have to amend your corporate or partnership or business tax return for 2020 as well.
Or for 2021.
Or for
Are
2021.
those pretty much the only 2 years that would have been?
That's the only 2 years that you would have to worry about the ERC credit, because at the fourth quarter of 21, that program was basically terminated. So
is there a hard deadline for those amendment filings? Has there been guidance on that?
You have 3 years from the date that you originally filed your return to file an amended return. But if you've already amended your payroll tax returns, technically you should already be filing your amended income tax return. You don't want to wait for the IRS to find out that, hey, you filed an ERC amended return but haven't filed your income tax return, because you could be subject to other penalties for not filing. So I want to go back to the fact that the IRS has 6 years to audit your ERC or your payroll amended tax returns. You only have 3 years to amend your amended return. So if you filed for an ERC credit, you filed an amended return for your income tax returns. You paid your income tax on the amended return. Year 4, year 5 after this time frame, you get audited on your ERC. They find that your ERC was not valid. They're going to bill you for the ERC credit that you received. They're going to tack on interest. They're going to tack on penalties. You will have no ability to go back and amend that amended return because it's out of statute. So you will have lost not only your credit, not only the penalties and interest you have to pay on the credit, but you will also lose on the income tax that you actually overpaid at this point. All of this is to say that if you filed an ERC and you're not 100% comfortable whether the ERC was calculated correctly, you should reach out to us so we can discuss your options. If you are comfortable, then just be aware that the IRS is probably going to audit a lot of these. So even if you were in the right and you were entitled to it, you may still have to deal with an IRS examination, or at least some notices or questions that may pop up. I think you were mentioning, Christy, that they've already mailed out.
They've already mailed out 20,000 notices denying ERC claims.
Yeah.
That happened just last month.
And that doesn't mean, like, if you get that notice, doesn't mean that you may not be entitled to it, but they're initially going to deny it. So you're now going to have to fight for it. They're also, as we mentioned, they are starting to examine these. The scary part is they're not examining them with normal IRS auditors. They're examining them with their criminal investigation unit, which is essentially the legal arm of the IRS. So they're looking at this not only as you owe us because you mistakenly did it, they're going after it that you criminally committed fraud.
Well, ultimately, don't they want to see if they can net in some of the bigger fish that were farming this out and aggressively marketing to
Yes.
potentially mom and pops and getting them to file this?
That's the big challenge, right? If you used a promoter, even if you were entitled to, but you used one of these promoters to do your refund claim, you could get swept up in the mess because they're going to go after that promoter and they're going to by default assume all of the claims that promoter did were bad. And now you're going to have to fight and argue that no, mine was good. That yes, I used the promoter, but it wasn't because I was a bad guy. I just happened to use them. This is all just to be aware. And again, if you have any concerns that you may have filed a bad claim, it's best to reach out to us because they do have some programs that are actually not a bad deal. One of the programs allows you to say, hey, I think my claim was bad. I didn't know all the rules. I want to pay the money back. They'll actually let you pay the money back at 80% and keep 20%. And by doing that, you're basically pulling yourself out of the net. Now it's probably a lot of money, but it's less than what you could be facing if you get caught up. And unfortunately, there's a due date there that program ends. So that's that March 22nd, 24 due date that you see up on the screen. So if you have a claim that you think is questionable and you want to try to make arrangements, we should act now and you should act quickly.
Okay, we'll move on now.
Yeah, I think I beat that to death.
It's scary for a
Yes.
lot of people too.
Yeah.
The beneficial ownership information report. We talked about this a little bit about 2 months ago.
Before we jump there, sorry,
That's
backtracking.
okay.
That ERC, initially the ERC was you were allowed to amend for your 2020 returns. You could amend those all the way up till April 15th of 2024. So if you filed a payroll tax return in 2020, did not claim your ERC, but were entitled to the ERC, you could still amend that return all the way up till April 15th of 2024. And for 21, you would be able to amend all those payroll returns up to April 15th of 2025. There is currently a tax bill that's working its way, it's worked its way through the House. It's in the Senate right now. If that bill passes, they're funding that bill by terminating the ERC program effective January 31st, 2024. That means that even though prior guidance said you had till April 15th of 24 and April 15th of 25, that's going to go out the window if this law passes. So if you haven't made a claim, you may not be able to make a claim for a refund at this
Well, they
point
haven't
if the law
lifted the
passes.
moratorium.
They haven't lifted the moratorium, but if your claim was in process prior to January 31st, it would still be in process. They wouldn't not process the claims that have already been submitted, but any new claims after January 31st would, if this law passes, would not be valid.
Okay.
So something to keep in mind, if you haven't already filed, it may be too late. Again, we don't know whether that law will pass, but right now, that's the way that law is written.
And then this is another hairy one, beneficial ownership information report. We did talk about this a couple of months ago. This is an entity reporting requirement that is going to kick into high gear effective January 1st of 2025. And what's a beneficial owner? You're a beneficial owner if you own 25% or greater of the entity, or you have direct or indirect control over said entity. And that's where David says things get kind of sticky.
Yes. So anybody that owns an LLC, an S corp, a limited liability partnership, any type of entity where you have to register with your Secretary of State, that is an entity that's covered under this new law. The 25% ownership is pretty cut and dry. If you own the company, you own more than 25%, you're covered, or you're going to have to report. The part that's when they say beneficial ownership, they're also looking for people that have control of that entity, even if they don't have ownership interest or a smaller ownership interest. So you could still be required to report if you're the CEO or the operating LLC manager. You'll also be considered a beneficial ownership for this reporting purpose. So it is something to be aware of. Anybody that was in existence prior to January 1st, 2024, we have till January 1st, 2025 to do the initial filing. Or you have until January 1st, 2025 to do the initial filing. The hard part is, though, if you open up a new entity in 2024, you'll be required to do that reporting 90 days after you create the new entity. So if anybody's created a new entity between January 1st and today, your clock's already ticking, and we need to make sure that you get your FinCEN, or you make your FinCEN reporting before that 90-day window expires.
And I know this will come up. This does not apply to sole proprietorships, correct?
Correct. Does not.
So if you have a Schedule C,
You don't. Schedule C.
unless you're a single member LLC.
Yes. Yes. So for all those people that did create LLCs where they're the only member, unfortunately, that does fall under this umbrella. So you'll be required to do this beneficial ownership reporting.
This would be only for non-incorporated
Right.
entities. And we are recommending that if you are going to need to file this report, either at some point this year or next, that you do begin the process of securing a FinCEN ID. And you can literally just Google FinCEN ID. It will facilitate the filings. If you require or request our assistance with these filings, we will not do it unless you have a FinCEN ID. And it's
So the main thing that this FinCEN is, or this BOI reporting is trying to do, is it wants to get a database of all the owners and collect the demographic information, like your name, your address, some form of secondary ID, your social security number, but also either a passport or a California driver's license or a FinCEN number. The challenge is anytime any of the information on one of those forms of ID changes, or if your business has a change of address or change of ownership, you now have a new window. You have to now go and update your FinCEN. It will be impossible for us to track that for all the individuals that may be owners. So the best way is to put that onus on the individual that is an owner in an entity. What that means is when you register for your own FinCEN number, you're going to put in the information, your driver's license, your passport, whatever you use, and they'll issue you a FinCEN number. The benefit of that also is, though, you won't have to do it for all of the other entities. So if you're a partner in 6 different entities or an owner in 6 different entities, once you get one FinCEN number, you will use that FinCEN number for reporting of anybody that requests.
Or if you have rental real estate property and LLCs hold, 6 different properties, you're
Correct.
going to have
To do it
filing
6
is gonna be
different
written.
times, right? So you'll
That's
still
gonna
have to
make it
do the
easy.
6 different times, but with one FinCEN number, it will make it easier.
Okay,
Sorry.
that's
bumped
okay.
you.
All right, so I think we've done that one. All right, so now we're going to talk a little bit about section 179 and bonus depreciation. And this is the act that David was referring to that has passed the House. It's now going to the Senate, and there are a bunch of different provisions in this. And one of them is to reinstate bonus depreciation at 100% for tax year 2023. So
and back to 2022,
22.
retroactive.
Yeah. So here is the 2022, we had 100% bonus depreciation.
Correct.
So effectively 2023 would have 100% bonus depreciation.
Correct.
For any piece of equipment purchased.
But right now, in case that law doesn't pass, we're only going to get 80% this
bonus
year.
depreciation. So if you
Correct.
buy a vehicle that is not going to qualify for 179 because it's not a heavy vehicle, your truck or piece of equipment will not be eligible for that unless you bought the 170. The vehicle won't be eligible for 179.
Right. But if you had heavy equipment or not heavy equipment, but you just had equipment that qualified, you may be able to still get 100% depreciation by combining bonus depreciation and section 179. Again, we won't know whether this Tax Relief for American Families and Workers Act, whether it will pass the Senate until the Senate passes it or doesn't pass it. I listened to a couple different podcasts and been trying to keep up with where it's at. Best guess is that it won't happen until the end of February or the beginning of March. So our recommendation is for any of our business clients that may have items that could qualify for the 100% bonus depreciation, that we'll calculate it based on current law right now. If we think we need to make an estimate by March 15th to pay in any tax on the IRS or the state, we'll do so, but we'll most likely put you on extension and wait for the final passing of this law. Otherwise, you're going to file your return. We may ultimately have to either amend the return or hope that the IRS automatically corrects the return, which is unlikely. So just something to keep in the back of your mind. The other thing is, if that law does pass, it would reinstate that 100% bonus depreciation, like Christy said, retroactively to January 1st of 23. So we'd be able to use it for last year. It would apply to 24 as well and through 25. 25 is going to be a weird year. So the way that the current tax law is written, everything is supposed to revert back to 2017 tax law at the end. So all I can tell you is that our updates in that year are going to be fun. Because I doubt it's going
So
to
it's
reverse
reversing most of the the
the
TC.
IAA or whatever
Yeah.
whatever
Tax cuts and
the
jobs.
Trump
Yeah.
Trump tax law of
TCJA,
2017. Yeah.
So everything will,
So if this current law doesn't pass, then we're stuck with the 80%, the 60%, and it's going to continue to phase out. And then, like I said, at the end of 25, it's supposed to revert back to 2017 tax code. My personal opinion is I find that highly unlikely. I feel that Congress will act and do something different. I just don't know what that different will be, and a lot of it will depend on who we elect in November.
final slide is just a reminder that the IRS rate has increased to 8% on unpaid balances. And that's going
The
to,
FTB is currently at 7%.
so that will affect you if you're a C Corp entity and you owe, and certainly if you're pass through, which a lot of the businesses we're talking about today are your S Corps and your partnerships. So
it'll have less impact, like the federal interest rate has less impact on all of you that have pass-through entities because you don't normally owe any federal income taxes.
you're going to
So
see it on the
IRS,
personal side.
you'll see it on the personal side. For those entities, though, on California, you usually do have some sort of tax, whether it's an $800 or an LLC fee or a minimum tax
Or an S Corp.
or an S Corp. So your 7% interest rate. So in the past, people often said, oh, it's so cheap. I'd rather just keep my money. I'll pay it late. Just know that if you're paying it late now, that what used to be a 3% interest rate is now 7. So it's more than double what you were used to paying. And they do calculate interest every day you're late, and it's on a compounding basis. Now that rate is an annual rate, so it's not 7% per day that you're going to have to pay, but it will add up. If you wait 6 months, you're paying 7% interest on 6 months. It's going to increase your tax bill by roughly 3.5%. The other thing is if you owe estimates, like if you're a large LLC or a large S Corp and you have fees that are in the thousands of dollars, your estimates, if you make your estimate late, that interest rate also applies. So just beware that if you're in the habit of not making your estimates because you want to keep your cash flow, make sure your borrowing rate is less than 7%. Otherwise, you would be better off to just pay your estimated taxes and avoid the extra payment.
And that wraps us up for the business filing. Anything else you can think of? Well, we can check and see if we have questions here too. I'm gonna go stop sharing. People don't see any questions.
No, so I think just to wrap up then, if you haven't signed your engagements for this year, again, please reach out to us. We do need to know that your business tax returns are, for the most part, if you're on a calendar year, they're due March 15th. And we are filing extensions for our clients, but if you haven't signed an engagement, you are not a client for this year. We will not be automatically filing an extension for you. So you will need to re-engage us for this year so that extensions are paid. And
Extensions are filed.
extensions are filed, yeah. And like we mentioned before, with the interest rates going up, we are recommended that if you do owe money for your last year's taxes, you're going to want to make a payment with that extension, even if we don't file the return. So very important to get in touch with us if you're not already engaged. For those of our clients that are engaged, we will be reaching out to you and making sure, letting you know that extensions have been filed. And if we think that you're going to owe, we're going to recommend that you make those payments. Okay.
Thank you for your time, everybody. Have a good night.
If you are going to join us for the individual, it is a separate link. So make sure that you join at 6 for the individual update. Some of it will cover again, but most of it will be new information. So please join us for the individual update at 6. If you haven't or didn't sign up for the individual update, You can go back to the link with this one. You can register and pop in. Hope to see you there. We will also be recording this and posting it, sending out a link for everybody that wasn't able to join live. All right. Thank you.
Thank you very much.